going to be doing a two-track presentation tonight. I'm going to be talking partially about how to invest in the modern era, and I'm also going to be talking about how my industry has evolved over the last 25 years. So if anybody is thinking about going into wealth management or investment management, how that might guide you over the next 10 years. And I got to tell you that 35 years ago, when I was sitting where you guys are sitting right now, there was a panel sitting here, and there was a guy who explained that his job was to, he had a phone, and he had a phone book, and he had a desk, and his job was to dial for dollars all day long, bang, 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 call, call, call. And that is totally not how my industry works today. It's totally different. So I'll give you a bit of background about myself. I'm class of '83. I was a history and math major. I had worked 3 summers at JP Morgan Bank, and I thought I had a pretty good resume, but I graduated in the midst of a giant recession. And I couldn't get a job doing anything in 1983. I applied to 25 different banks, got 25 rejections, graduated in May, moved back home. My parents were really annoyed with me because they thought I was supposed to get a job coming out of Hamilton College. And I spent the summer taking classes in computer science, which was a brand new thing, and accounting at Columbia University to stall for time, and bartending and tutoring to make some money, just to kind of figure out what to do next. So if anybody has any concerns about how their career process is going right now, don't worry about it. It will work out eventually. And this is a much better time to be looking for a job with 3.7% unemployment than it was back in 1983 with 9.7% unemployment. Through a little bit of hustle, I ended up getting a job at Morgan Stanley in the systems department. And when I got to my interview, the guy looked at me, he looked at my resume, he looked at me, looked at my resume, put my resume down and said, "David, let me understand this. You've got a history and math degree, and you're applying to a systems job at Morgan Stanley. How's that going to work exactly?" I said, "Well, when you study history, you learn about the big picture. When you study math, you develop a quantitative toolbox. Hopefully you can quantify the big picture and make some money." He goes, "Dude, if you can sell that to a client, you're our guy." And that's pretty much been my entire career, taking complex concepts and clarifying them and simplifying them so people can make good decisions. So let's kind of jump into things. I'm going to start by asking 3 questions to kind of get some group involvement here. And so the first question is, why do we invest?
To make money.
To make money, okay? Other thoughts? Any other reasons to why do we invest? Right? So Hamilton College has a huge endowment, and that endowment spits out 4% a year, and that endowment subsidizes about 35 or 40% of everyone's education. It pays for the buildings, it pays for scholarships or whatever, right? At the personal level, everyone has short-term needs, medium-term needs, long-term needs. Right now, everybody in this room is between 20 and 23 years old, 24 years old, right? Your needs are pretty simple. Nobody here is worrying about retirement right now. But you might be worrying about graduate school. Or you might be thinking, hey, by the time I'm 30, I might be married. I might be starting a family. So we invest to take current income and convert it into future resources. It's very important to have that very clear in your head. It's not a game. It's not for fun. It's not to beat your brother-in-law. It's to solve your own problems. Another question. What is risk? If you routinely ski aggressively, is that a risky behavior? Right? So you look like you ski. Why is that a risky behavior?
You can get injured.
You can get injured, right? Can you get injured in the stock market?
Emotionally.
Emotionally? Yeah, we'll talk about emotions. Emotions are very important in the stock market. Is the fact that the stock market sold off sharply in October, is that an example of risk? Anybody think it is or not? The answer is it might be. If you had a house closing on November 1st, and all of your money was in the stock market on October 1st, you'd have 10% less money a month later. So that would be volatility risk. But what if you didn't have any need for that money until 20 years from now, and you needed it for your retirement? Would the fact that the market rose or fell 10% in October be of any interest you at all? No, you wouldn't care about it at all. In the instance of retirement money, the risk is it doesn't grow enough to throw off the income that you need when you're 65 years old. So risk is not volatility. Risk is not inflation risk. There is longevity risk, the chance of outliving your money, right? Risk boils down to the chance that money won't be there when you need it. So when you're investing, you tend to divide your assets into different pots. If it's a need of the next year, a house closing, a tax payment, a tuition payment, you can't take any volatility risk at all. It has to be in cash. If it's a need of the next 1 to 5 years, you've got you're saving up for graduate school, you can take some more risk. You can put it in the bond market. If it's a need of 40 years from now, 50 years from now when you retire, you can take a lot of risk. You can put it in stocks on margin. Risk is defined as the chance money won't be there when you need it.
Would you recommend buying an ETF today, given how strong the market is?
Okay, so let's talk about, should you buy an ETF today? First question is, what is the time horizon? Is it a day, a month, a year, 5 years, 20 years?
Let's say like 20 years.
Boom, you go for aggressive growth ETF. Okay? Because before we were talking about what is risk in investing. And so it's not volatility risk, right? Like the fact that the market fell 10% last month, you won't remember that 3 months from now. The market fell 10% in February, March, and April. Nobody remembers that, right? I do personally remember the sell-off between September 2008 and March 2009, because it was 55%, and that was like the longest 6 months of my entire life. I knew eventually the market would turn around. It just took each day was horrible, all right? So if you have a 20-year time horizon, you would go with an aggressive growth ETF. And you can, slice and dice. You can start out with the Russell 3000, which is a pretty comprehensive index, and slice it into the Russell 3000 growth component, or you can slice it into the Russell 2000 growth component, which is a small and mid-cap component, which grows faster than the large cap component. So you can do that. Now, if you told me that my time horizon is 5 years, I'd say, well, there's some bond ETFs you can use instead. And if you told me your time frame was the next year, I'd say, you know what, just leave it in cash. You just can't afford the risk. How do we make decisions? Anybody think about that? Because when you're investing, you're making a lot of decisions. How do we make good decisions? How do people remember how they made decisions about what college to go to? Nobody remembers how they made. How do you choose Hamilton?
I liked the atmosphere.
You like the atmosphere. Okay, so you looked at a number of schools, right? You had a stretch school, a safety school, a couple of schools. Hamilton came out on top. All right. Was that an emotional decision, or was that a rational decision based on data analysis?
Emotional.
Emotional, yeah. So here's the funny thing. We live at the apex of human civilization. We have literally trillions of bits of data available to us 24/7 at our fingertips. And yet, our decision-making process is exactly the same as our caveman ancestor from 10,000 years ago. So if that guy heard a snap of a twig in the woods, his brain came up with 3 quick ideas. Number 1, it's food. Number 2, it's a mate. Number 3, it's a tiger. Oftentimes, that guy just plain ran away. And in so doing, gave up the opportunity to find food or a mate. But he also gave up the opportunity of being eaten by a tiger. His peers that were more thoughtful and methodical about their decision-making process got eaten and didn't get to reproduce. So here we are 10,000 years later, thinking we're always making good decisions, but in fact, we're always making emotional decisions. So 98% of people, regardless of intelligence, regardless of education, are not qualified to be good investors because their emotions take over. And emotional investors are poor investors. They buy high and sell low, buy high and sell low. I was here doing a presentation a couple years ago, and I asked about whether people thought Bitcoin was a good idea or not. Anybody here own Bitcoin? At this point, no? Right? So Bitcoin soared and then cratered. It's worth about 2/3 of what it was at the peak, eventually be worth zero, whatever. But this time a year ago, people were buying Bitcoin on credit cards. They were that enthusiastic about it. And those people have lost all their money. The way you get around emotion is you use rules. Everything that happens in my firm is based around rules. So boring. If my job was like being an accountant, I would be so happy. That's the way it should be. And by the way, there's not just one way of being a successful investor. There's about 200 different strategies that you can use. And the way you become a successful investor is you find a strategy that fits with your psychology, and then you follow that strategy slavishly in good times and bad. Good times is easy. If the strategy is going against you, the worst thing you can do is jump out of it and try and follow someone else's strategy. So that's the kind of the macro picture. Let's go micro for a few minutes. Two companies, Facebook and Google. First off, what industry are these companies in?
Technology.
Technology. Okay, what else do they do?
Bring people together, like social media.
Okay, so social media for sure for Facebook, right? Who are their customers?
I think they would say everyone.
They would say everyone. All right. Here's a tough question. Who pays the bills?
I don't know.
Advertisers. Advertisers. So in fact, whenever you're analyzing a company, you always have to ask yourself, where does the revenue come from? In case from Google, it comes from advertisers. In case from Facebook, it comes from advertisers. So in fact, they're both in the same business, selling advertising. They have a different approach to it. This is just a screenshot from Morningstar. There's about 50 other pages we could look at. We're only going to look at a couple items for here. Like, for example, here's the kind of company it is. It's a large cap growth. It's kind of obvious. It's got a PE ratio of 22.6. That's not bad. The entire S&P is about 20 right now. Okay, so a lot of it's relative valuation. A price earnings ratio is, if I have a $20 stock and I have $1 of earnings, the PE is 20. The forward earnings ratio looks pretty good as well. It's low. Price to book, always high for a technology company because they have no real assets. Likewise, price to sales, if that's 1, that's a great number. So 8.5 tells me it's pretty aggressively valued. But all in, the Morningstar analyst says this company is currently undervalued by about 19%. So that could be an opportunity. Here's the exact same information for Google. It's also a large cap growth. It's got a much higher PE ratio, although next year looks about the same. Similar price to book, similar price to sales. It's also undervalued by 18%. So, without going too much further, I might say these companies could be equal as a decision point. That's the quantitative analysis. Here's the qualitative analysis. Show of hands, who used Google today? Right? That's everybody in the room. Show of hands, who used Facebook today? So we got 1. Okay, so we got about a half the room. All right? When you go to Google, you are definitely looking for something. Like, I buy stuff all the time, and I jump on Google or I jump on Amazon, and I'm looking for stuff to buy. I don't actively use Facebook anymore. I don't have the patience for it. My kids don't have the patience for it. I used to spy on them, but now they've got a beautifully curated page that shows them what they want me to see. And I definitely don't pay a lot of attention to the ads that are scrolling along the side. I do know that Facebook is making a lot of money off of that. It's got some pretty good revenue numbers. But I'm concerned that Facebook will end up like MySpace. Anybody ever use MySpace here? One person in this room used MySpace. Before there was Facebook, there was MySpace. It was the bomb. And then one day it became empty space, and nobody uses it anymore. And so if I had to choose between Google and Facebook, and I would choose Google because I'm worried about Facebook's long-term business plan. And that's a qualitative analysis. Well, here's the next question. is there any value in doing this work at all? Because remember before I was talking about, I had information advantage 25 years ago. When I started at my firm, I was getting S&P reports to the fax machine. I had good information. And I was, on the other side of the markets were a lot of dumb money, a lot of day traders, a lot of amateur investors, a lot of amateur brokers, whatever. They didn't really know what they were doing. And people like me could harvest their mistakes, add them to our returns, and create what we call positive alpha. If the market goes up 10% and your returns are up 12%, then the 2% difference is the alpha. It's the extra return that you created through your hard work. All right? So 25 years ago, it was very easy for me to add 2% a year to my clients' returns. These days, it's impossible. Because these days, I feel like I'm Robin Hood, and the market is like Darth Vader. And Death Star beats bow and arrow every time. And what I mean by that is me looking at Morningstar reports or Bloomberg or any of the tools that I've been using for my whole life compared to the computational power available to the mutual fund complexes, the high frequency traders, the exchange traded funds. This is what happens every time. Luckily, I can have a thriving business that does not need to beat the averages. We'll talk more about that in a few minutes. Active versus passive investing. The problem is not just with my firm, it's with every firm. Fidelity, T. Rowe Price, American Funds, Janus. These are all the fund companies that for decades were very successful with active management strategies, where they were aggressively buying and selling stocks, trading a lot, looking for good ideas, overweighting positions. Meanwhile, there was this other company, Vanguard, that took a much more passive approach. Vanguard said, hey, listen, we're just dumb hicks in Pennsylvania, and all we're going to do is buy the S&P 500 and put a lot of money into it and keep our fees really low. And so the passive funds first popped up around about 1996 or so, really began to rumble in the 2000s. And for a decade or so, we were asking ourselves, well, which strategy will win, the active strategy or the passive strategy? Well, the problem with the active strategy is that it generates a lot of capital gains. The problem with the active strategy is it has a lot of transaction costs. The problem with the active strategy is it tends to have high management fees. But if we're in an era where the ability to create positive alpha has disappeared, and all that's left is beta, which is the actual market return, and now you're subtracting the costs of your strategy, well, now active management equals negative alpha. The passive firms, they're hugging the benchmarks more closely. So at this point, I've told my team we give up on trying to aggressively beat the markets. We have our clients' assets divided into three pots. We've got our original stock and bond platform. We have our mutual fund strategy, which we're moving away from, and we have our passive ETF strategy, which is pretty robust. And even in the stock and bond portfolios, what we're doing is using our rebalancing tool to take stock portfolios and convert them into index portfolios. We're not trying to beat the markets anymore, just hang close to them.
Which index does your firm tend to track the most?
Which index do we use? So once upon a time, a guy created the Dow Industrials. That was the original index, and that's a terrible index. Never use that one. The reason why it's terrible is because it's price weighted. So a $1,000 stock has 10 times the impact as a $100 stock. It makes no sense at all. The S&P 500 is an index that people often use. That's pretty good for if you're strictly a large cap investor. But actually, we're all cap investors. So we tend to use the Russell 3000. And that covers 98% of the stock universe. But we also throw in the Morgan Stanley Capital, MSCI, Morgan Stanley Capital International, Europe, Asia, Far East Index, because that is the whole world minus US, because we usually have about 10 or 15% international exposure. We also throw in the Barclays Aggregate Bond Index. And this is how you use benchmarks in investing. You don't obsess about whether you're beating the benchmark or trailing the benchmark, too much. The benchmark is like the tachometer in your car. It tells you what the motor is doing. So obviously, if you're well below your benchmark, you've got a problem. If you're well above your benchmark, you've got a problem. You've taken on risks you don't understand. But generally speaking, if you're plus or minus 2% on the benchmark, that's good enough. You still have to look through the windshield and look down the road to see what's coming. So how should you invest today? I started investing when I was 17 years old. I really felt like I got the hang of it by the time I was 30. Everything's moving a lot more faster these days. If I were you, I would go with Robo-Advice. Has anybody heard of Robo-Advisors yet? Nobody? So a Robo-Advisor is a completely internet-based service. We'll talk about some providers in a minute, which gives you an easy account opening process, low-cost passive ETFs, so the same ETFs that I invested for my clients, low management fees, usually 0.25% a year to 0.4% a year, very low. We charge 1% a year, and tax efficiency. They will actually harvest your tax losses and try and keep your tax gains down, just like we do. But the entry levels are much lower. We used to have $1 million account minimum. You can get into a robo for $10,000, maybe even $5,000. The firms that dominate the space are Vanguard, of course, Charles Schwab Intelligent Portfolios, Betterment, Wealthfront, and Personal Capital. Those are all newer firms. Those are what we call fintechs, financial technology companies. We've used all of these at our firm just for curiosity. I happen to like Betterment the most just because I think the interface is the easiest to use. It's the most attractive. But if I was anybody here who was 2 years out of school and had $5,000 extra, $10,000 extra, I'd open a robo account with one of these firms. So where does that leave people like me? Have I been replaced by a robot? Interesting question. I mean, has anybody ever used a travel agent in their entire lives in this room? There was a time when there was a travel agent on every corner of America. You know where the Starbucks are now? That's where the travel agents used to be. They're gone. They've been replaced by Expedia and Hotels.com. I used to do 100% investment advice. At this point in my career, it's down to 20%. I spent a lot more time on financial, tax, and estate planning. That's a lot more complicated than just investing. I also spend a lot of time on behavioral coaching. That is the fun part of my job. That is the family therapist part of my job. That is the preventing the clients from harming themselves part of my job. Very typical. The market took a tumble last week. I'm going to get some phone calls from clients saying, David, I want to sell stocks and buy bonds. And I'm like, so what you're saying is you want me to sell low and buy high. But I told you back in July this was going to happen, and I already changed your portfolio back in July. So why would we change it again? We've already done the work we needed to do. You're fine. Oh, and by the way, let me show you how the rest of your portfolio is doing. So behavioral coaching, helping the clients make good decisions, helping the clients stick to the plan. That is worth a lot because, as I said before, 98% of people, regardless of intelligence, are not qualified to do this for themselves. Here's another thing that we've done. The rise of the Bionic advisor. Because of my technology background, I've always been very aggressive about bringing technology to our firm. And what I've realized in recent years is that clients want technology, they want transparency, they want to know exactly what's going on, they want it 24/7, 365, they want to understand the value of what I'm doing for them. We charge 1% a year. I think I add about 4% a year in total value to their portfolio. Hard to quantify, but I'm pretty sure it's in that range. And they still want to talk to a person. So even those robos I mentioned, Vanguard, Schwab, Betterment, Personal Capital, they've actually hired financial planners to work in call centers to take phone calls. And at this level, it's a random person, and then when you get to this level, you get a dedicated person. But when push comes to shove, if you have a bad Uber experience, whatever. If you have a bad hotels.com experience, whatever. If you have a bad Tinder experience, okay, whatever. But if you have a bad retirement experience, you can't retire. So people are really serious about their money. And they like technology, but they want to make sure there's a person backing them up. At our firm, every client has this dashboard. And over here, they can see their cash, their credit cards, their investments, their life insurance, their mortgages, their property, stock options if they have them. They can see the total value of their investments. They can see the total value of their net worth. We also can track their spending and help them with budgeting and things like that. This information is available to them 24/7 on their PC, on their iPad, on their phone. There are scores more reports to go beyond this, but you always have that dashboard handy. And then also, because we're capturing every element of a client's life, the investments we manage for them, the investments we don't manage, their 401k, assets and another advisor, their mortgage, their credit cards, everything, because we see the big picture and we know everything about them, we can do really cool projections. So this happens to be our demo family, and we deliberately set up this family so that they would run out of money if nothing else changes by the time they were 88 years old. But we programmed them to live to 100. So that's a problem. Well, we can click a button and show them what happens if we have them retire 5 years later. The extra 5 years of income and savings solves the problem. Or they can sell a country house and throw that money back into the investment pot. Or maybe they're going to inherit some money. Maybe that solves the problem. So basically, whatever ideas a client can think of while they're sitting in their office, we can model it in front of them and show them results. Click on, click off, click on, click off. And you know how we were talking before about how the human brain makes decisions, right? We used to give people like pages and pages of PDFs of their financial plan, and they would never read them and never understand what was in there. But if I show you one screen with this picture, you get it. And more importantly, you know the decisions that you make today have big impacts 15 years from now. That's very valuable information. Can you imagine finding out here that you're going to run out of money? That's not valuable information. That's actually really bad news. So that's how we've adapted to become Bionic advisors, and that's how we're able to charge effectively double fees compared to what the Robos do for pretty much the same investments for sure, but so much more else goes around it. The complicated estate plans they get involved with, the complicated family dynamics, siblings fighting over grandma's country house, things like that. Oh, so entertaining. And so far removed from where I started out 25 years ago, actually picking stocks. At the end of the day, the time of trial and error is over. Getting it right the first time is so hard. So you got to bring in experts. And what our clients understand is that they have 10,000 choices, and they hire us to help them get to the 10 choices that matter to them. So that's where I'm going to end my formal presentation, and I will say, as long as people want answering questions either about how to invest personally or what's it like working in wealth management. Question back here.
Do clients ever specifically ask about, or ask not for you to put their stock in companies that say they have ethical reservations against?
Yeah.
How do you personally deal with these?
Yeah. So the question is, David, how do we handle the issue of socially responsible investing, or it's also called ESG, which is environment, social, and governance. And interestingly enough, I've had rules since 25 years ago about not investing in firearms or tobacco because I have an ethical issue about companies that kill people. But you can buy ETFs that are screened for carbon footprint, ETFs that are screened for gender diversity. There's about 6 major categories. Or clients can say specifically, hey, you know what? I never want to own energy stocks. I never want to own Philip Morris. You say, fine. And we just program it into our rebalancing tool to exclude however many categories of investments they don't want to have. And I used to worry that doing that would harm their long-term returns. But actually, if you're taking out 15 or 20 companies out of 500 companies in the S&P 500 or 13,000 that are in the overall stock market, it doesn't affect it at all. So we can accomplish a client's social goals and not harm their long-term returns. Question over here.
Do you think that really cheap investment companies like Acorns are useful for starting out, or
Tell me more about Acorns. I'm not familiar with that.
so that takes online purchases and rounds them up to the nearest dollar and then takes that and invests it?
Okay, so the question is, there are some fintech companies that I guess you would buy M&Ms for $1.89 and it would round up to 11 cents and put it into an investment account. Okay, so this is a way of gamifying your financial life and forcing you to do the things you should be doing anyway. And that would work pretty well in the beginning, but 11 cents here and 11 cents there isn't going to get you to your long-term financial goals. So what's more important is you get your first job and you stretch to make the highest commitment you can to the 401k. And let's say the company will go up to 18% of your income, but you can only afford 6%. Well, fine, you start at 6%. And then when you get your first raise, you automatically bump up your 401k holding by 1%. And on an after-tax basis, it's not going to hurt you at all. And then every time you get a raise, you keep bumping up your 401k withholding until you're at the maximum match. And if you happen to have the good fortune of working in a company that will match you, you go for as much money as you can to get that match going. Hard to come by these days. And then you commit to saving outside your retirement plan. A lot of clients say, well, David, I maxed out my 401k. I guess I'm done for saving this year. I go, no, you're not. You can throw $1,000 a month or $500 a month or $250 a month, whatever number feels comfortable, into an automatic investment plan at Fidelity, at Schwab, at Vanguard, and you get this snowballing effect, and you also get the beauty of what we call dollar cost averaging. So when the stock market's high and you put in $1,000, you get $1,000 of, you get fewer shares. But when the market's lower, you get more shares. And over time, it builds and builds and builds and builds and builds.
So if you were 20 years old today, how would you be investing your money?
100% stocks.
Okay.
Question was, if I was 20 years old, I was investing today, how would I invest my portfolio? And the answer is 20% stocks. Because realistically speaking, unless you have a big college loan debt hanging over you, no, awesome. You've got limited housing expense, you're not married yet, you don't have a family yet, you don't have any significant expenses towering over you, so throw all that spare cash flow into an aggressive index portfolio, get it growing for you as fast as you can, don't worry about what happens in the next 5 years. And then as your life evolves, then you'll make changes. So for example, the portfolio at 20 is not the portfolio I recommend at 40. We talk about the glide path to retirement. At 40, well, now we're more like 80% stocks and 20% bonds, because yeah, we want that growth, but we also want some stability there. And by the way, there might be some college payments coming up. And then at 55 or 60, now we're at about 75% stocks and 25% bonds, because we're really trying to dial down the risk. And when someone retires for good, it's 70% stocks or 65% stocks or 60% stocks, because now we're creating a lifetime income stream out of that portfolio, and the stability of the portfolio is more important than maximizing the growth. David Edwards, class of '93. I'll be around for a bit longer. Have a good evening.